But yields are sinking today. Even as we're talking about the long-term fiscal sustainability of the U.S. government, maybe Rick Santelli, who is back now, can explain. Hi, Rick.
Hi. You know, whether it's the month-end, quarter-end, half-year-end effects, or just in general, as the last guest, Steve, pointed out, and so appropriately, sometimes markets don't trade on fundamentals. And on the interest rate side, there has been a global propensity for lower rates. But everything you said is true, Kelly. This administration's budget, if it passed in the current form, certainly doesn't seem like it's in any serious way addressing the deficit, although in any serious way, it also isn't the main driving force at the moment. Now, if we look at 2s and 10s on one chart, you can see interest rates have moved down. It started primarily with the short end, and then all of a sudden, the long end caught up. The curve's actually flattening. If you look at 2s and 10s, they're both on pace for the lowest yield close since the very first day of May. And there's other issues going on. You know, it's always a race between our rates and various rates around the globe to see who can bring in capital. Well, if you look at our 10-year yield versus the European or the German 10-year yield, that difference right now is around 163 basis points. That's the closest it's been since early April. We need to monitor that. And finally, everybody's talking about how weak the dollar is, weakest since Feb of 22. Our last guest said good for multinationals, and he's right. But look at the euro currency. The euro currency right now is the strongest it's been against the dollar all the way back to September of 21. And they're an export economy. We're a consumption economy. They're going to have a tougher time with a stronger currency than we're going to have with a weaker one. Kelly, back to you.